Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So Southwest, so ticker LUV, is down 14%. So the company plans to cut capacity this year, halt most hiring, and review its spending plans in response to reduced aircraft deliveries from Boeing. Here's my question. Is this going to be as simple over the next year? All the airlines are going to raise their fees and they're going to say, it's not our fault. We got to cut capacity because of Boeing. I wonder if that's what we're going to hear. Well, joining us now is George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. George, is that the thing? Let's just blame Boeing for the things and then raise our prices?
Well, so not everyone will be able to blame Boeing, right? So there are airlines that are operating Airbus aircraft. Companies like Delta, JetBlue, Frontier, Spirit, they won't have the problems that airlines that are being supplied by Boeing will have, and they'll look to put as much capacity in the marketplace to take advantage of the fact that the airlines that are flying Boeing product aren't able to get all of the flying done that they want to do. The truth too here is I think that the Boeing challenges will provide a little bit of firmness to the marketplace. But I still see, I think, a U.S. airline market that looks like it's got has plenty of capacity in it. And I still think fares are flattish to maybe going down for the year unless Boeing really curtails their deliveries for the year.
Yeah, it's interesting because if I read this issue about Boeing and I read this cut in capacity, but my first thought is going to be that means higher prices for consumers. So what accounts for the difference there?
Well, first of all, I think the U.S. market already had sufficient capacity last year, right? I think we're bouncing back from a pandemic. We saw a bunch of sort of revenge travel, earlier in this bounce back. And that was very leisure driven. I don't think we're going to see as much of the leisure driven travel this year. Not I got to pay whatever it's going to take to get down to Disney. So you'll see maybe a smaller growth amount in leisure. And business isn't fully back. We know that. So we've got more than 2019 levels of capacity in the marketplace, less business, and maybe a little more leisure. So when I add that all up, again, I kind of see a market that looks like it's got plenty of capacity. If you look at the guidance that Southwest gave on revenue per available seat mile, they lowered that at this discussion. So it tells me that the market is weaker at this guidance point. The market is weaker than they initially thought, and at the same time, fuel prices were a little bit higher. So what it looks like to me is Southwest numbers are going to come in lighter than we expected in 1Q. That's not a super healthy market. That's not a market that's got so much constraint that they can price whatever they want to for airline tickets and make lots of profits.
Okay, so it's like a trifecta. Like they do have a specific Boeing issue in the fuel prices and then the broader softer market. That's a general airline issue. United also told Boeing to stop building 737 MAX 10 jets for the carrier. Yes. Okay, that sounds dramatic and bad. What does that actually mean?
I think it sounds like Scott Kirby, the CEO of United, is just getting real about what he thinks Boeing can deliver in the near term. I guess, if you sit around and you kind of hope and hope and hope they're going to get the MAX 10 certified, and you wait on those deliveries based on that hope, and the certification keeps getting pushed out, and it's really hard to plan. So Scott Kirby said, hey, look, stop worrying about the Dash 10, just bring me Dash 9. He was saying, look, I just want airplanes. Bring me airplanes. I think the market's generally going to be strong for me. He's in the premium segment too, right? Which I think from the guidance we saw today from airlines, premium is holding up better. So he wants airplanes. He wants to go out and find some of those 321 larger scale from Airbus. Again, I think it's okay. I think Scott's being a realist. There's a lot of challenges right now at Boeing, and it feels to me like certification for the Dash 7 and the Dash 10, the Dash 10 being the biggest variant of the 737. There's just almost no way they're going to get pushed out longer than what we expect, given the problems in manufacturing at Boeing right now.
And what is that? So is there any read across that we should start thinking about for Airbus?
Well, I mean, here's the challenge of this industry, right? The read across is, look, Airbus ought to be able to go get a lot more orders for its Airbus A321. But the problem Scott has, and he's a really good customer, and they're working hard to find him slots, is that they probably can't get him 321s for 4 or 5 years from now.
Wow.
So that doesn't fix his near-term problems. And customers that would be smaller than United have an even larger problem because Airbus isn't going to work as hard to try to get him into the delivery cadence. The industry is operating at sort of max capacity now. It's pushing its supply chains to do better, but we just don't see increases of build rates kind of more than 10-ish% per year at best. It's really hard to bring up that supply chain. So I think the duopoly means that Airbus can't really capitalize that well on this.
Just anecdotally, I flew to Houston for like a day last week, and I flew there on a new Boeing jet for United and back on an old one, and man, that was different. That was a very different experience.
Did you bring a wrench with you?
Okay, I did text my husband, and I was like, hey, so I'm on this Boeing plane just in case something happens. I know, I'm like that. What is the floor, though, George, for Boeing? I mean, the stock is literally dropping like a knife here. Are we looking at the October low is what we have to be watching? Like, where's the support, and where is the support going to actually come from?
So, look, it's, Boeing has been through some real troubles, and the bad news sort of keeps coming. Look, it's hard to say what a price would be on that floor. I will say that I think their purchase of Spirit that they've proposed could start to put a floor underneath their problems. I see that direct line of management from the Spirit floor in Wichita, Kansas, all the way up to Boeing in Renton, Washington, as being the ultimate solution to improving quality, oversight. So I think we have to watch that development closely. It's going to require getting some of the Airbus business outside of Spirit, because Spirit builds products for the A320 for Airbus and the A350. I don't think you want that inside Boeing. So this is going to be a complicated procedure, a complicated purchase, but I think that's the beginning of Boeing really getting to stabilize their builds, improve quality, and that's going to make the FAA free up FAA time and open the FAA's mind up about certifying MAX 7 and 10. So I think that's the beginning of it.
I mean, if you think about what the challenges are facing Boeing, is there much of a difference to the company if we get a soft economic landing, a hard economic landing, or no landing?
Honestly, I think for all the airframers, there isn't, right? So again, Airbus and Boeing building aircraft at rates much lower than their customers are demanding right now. Customers like Scott Kirby want to come in and buy A321s next 3 or 4 years, can't get them. So I think even in a hard landing, soft landing, no recession environment, these folks just keep working on making the supply chain better so the supply chain can put more of the components on the factory floor and build more aircraft. Although I would say maybe in a harder economic landing, it might free up some of the labor that they need and keep some of the labor more stable at their suppliers. And that's really the challenge right here is labor at the suppliers, stabilizing it. You need smart people there who've been doing the process for a long time so they do it right all the time, know the right processes and procedures.
Hey, George, if anyone listens to the show or watches TV with me, I am a deal person. I like me deals. I like all the deals, whatever the deals. If I want to look for deals for flying, where am I going to get that? Like, is it literally going to have to be sort of regional companies exposed to Boeing? Like, am I going to have to get that granular here?
Well, no, right? So the way I mean, airline seats, all the CEOs would complain that I say this, but I really find them largely as commodities, right? And so if you're going to find lower fares, I think you're typically going to find them lower across the board. We are seeing, it does seem to me that non-premium leisure is an area of especially good, a lot of seats available, especially good prices, maybe the further down the curve you go on it, you may not want to go that far down to the Spirits and Frontiers would even be some of the best deals. But Southwest guidance today means that even in a nicer, non-premium product, they're still having challenges getting fare, and so I think that's important. That's good.
Oh man, fine. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. And let's be fair. I want to sit in the front of the plane.
Who doesn't?
You want to pay. You want first class, but you want to pay coach.
Boom. He gets me.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
NFIB small business optimism dropped 9-month low. There's that. Also, CPI month-on-month coming in at 0.4% for February, so slightly higher sequentially. For the year, you're looking at 3.2%, also higher sequentially as well. So warmer, wasn't hot. It did prove that January maybe wasn't a blip. I was calling it warm. Let's get the take now from Jeffrey Cleveland, a chief economist over at Payden Rygel. He is standing by with us for more. Jeffrey, is warmer the right way to phrase a CPI report, or is there another temperature degree word you might use?
Maybe spicy.
Okay.
Still too hot to handle.
Okay.
For policymakers, I think they're going to be unhappy with this sort of reading. So maybe one of those monikers would work here.
I like spicy.
Yeah, I mean, especially in food, but maybe not so much in inflation readings. So can you talk to us a little bit about why you've got this concern about what seems to me just to be a little bit of an overshoot versus expectations for inflation, because there's a lot of enthusiasm in the equity markets, for example, that the Fed might be on track.
Yeah. Okay. So I think the context here is Powell appeared on Capitol Hill last week, and he reiterated his view that we need to see monthly readings like we saw in the second half of last year. So I think he's referring there to core PCE, not so much core CPI, but we had some soft month-to-month change readings in the core measures in the second half of last year. So we need to see more of those, not necessarily better, but more. And a number like 0.4 for core CPI month-to-month for January, and again in February, for me, that's too hot. So it's going to disappoint policymakers from that perspective, because they want to be convinced that inflation is going to sustainably return to 2%. I think this raises some questions. January could have been a fluke, but 2 months in a row, not so much.
So does that mean we have to lower our expectations for inflation? Like, it's a trajectory, it's not the final destination kind of thing, as I think Powell's been alluding to?
I think investors should imagine that the Fed probably will cut rates this year, but it will happen later, and there'll be fewer cuts. So we have the first cut in September, and we have only 2 cuts for the year. That's going to be disappointing for investors.
So only 2 cuts for the year. Okay, that's interesting.
That's right. And that's looking at the destination where we think core inflation will end the year, but also thinking about the path to get there. I think while there's not a 1-for-1 here between core CPI and core PCE, could imply that when we do see the core PCE numbers later this month, they will also be a bit spicy. And so that's going to be, again, disappointing for policymakers.
What do you make of the market's reaction? I mean, we had very little movement in bond yields to start with, but now equities are very firmly up.
Yeah. I don't know. Maybe investors had a hint that the inflation would come in stronger. That could be possible. Or maybe it's just going to take a bit more time to digest the implications here. I know, just from talking to colleagues and coworkers and competitors, you hear kind of some positive spin here. The fact that February's core reading wasn't as bad or wasn't as hot as January's. So we did see a little bit of a cooling relative to January. So maybe some good hints in there. But I like to look looking at core CPI month to month, but also looking at median CPI. The median CPI, just looking at the median price change, that just dropped from Cleveland Fed, and that was also 0.4 month to month after a 0.5. So I still think underlying core inflation is a bit too strong. Market probably will wake up to this over the next few days.
Okay, so market wakes up to it. I appreciate you're an economist, but what happens? Like, we've already seen some selling across the bond market. We've seen sort of the back end catch up a little bit here with yesterday's selling in the front end. What's going to be the ramification?
Yeah, I think higher bond yields across the curve. Implication would be, pricing of fewer cuts, pushing out the timing of cuts. That could also have an impact on risk assets, equity prices, credit spreads in the bond market. I think that could ripple through as well. So, really, it's the bond market that is the key driver here of everything else. So the implication is higher bond yields for longer.
So now I want to ask you about a theme that, Alix and I were discussing this earlier, and we had some guests talking about the election coming up this year. How do you see things developing in the second half and indeed in the second quarter, or the fourth quarter, I should say? Because if you've only got 2 rate cuts, one of them's going to have to come either immediately after the election or in December. And so you must have a very particular view about what sentiment around lower interest rates is going to be at that time.
Well, I just think back to 2016. We saw a rate hike at the end of the election year. There's been some other instances. 2018 we had 4 rate hikes throughout the year, despite that we had midterm elections. I think investors like to talk about elections. They love to talk about politics, but really, I think it's going to be the inflation trajectory that determines what happens with interest rates, not the election. So, really coming back to that path for core inflation and then ultimately the destination. If we're right that the path is bumpier and we end up with higher core inflation at the end of the year than the market currently expects, then we'll get the fewer cuts. The Fed funds rate will end up being higher. I think that's the key story. The election, what happens there is not, I don't think it's going to change that. Now for 2025, that's where the election really matters, right? Because that could change the tone of fiscal policy in the coming year. So I do think if the Republicans take back the White House, then you could have a more aggressive or expansionary fiscal policy in 2025. And again, that could have some bond yield implications, but it's probably a story for late 24 and into 25.
All right, but put that aside for a second. So you see 2 this year, and then how many cuts then are you sort of mapping out for 2025? Like the whole rate cut cycle?
I think it's possible that you could see one, sort of a pace per quarter in 2025 of 1 cut per quarter. So you get an additional 3 or 4 in 2025, something like that. So certainly no slashing of the Fed funds rate, not anticipating on a 12-month horizon a recession. So I guess this would be more similar to what you saw in the mid-1990s, where we had, the early 1990s, the Fed hiked a lot. Rates went up a lot, but the economy continued to grow throughout that decade. So the Fed funds rate stayed in a pretty narrow range from, say, 1995 until late 1998. So
and there's
something more like that.
There's no dramatic fall off then in that perspective.
The question is, how would you get a dramatic fall off? To me, it has to be an economic downturn. It has to be a recession. So you have to have that in your forecast. We're more upbeat. We think the economy will continue to grow out over the next year.
He does seem upbeat, doesn't he?
He is very upbeat.
Yeah, even like looking at him on YouTube, like his energy is like he's into it. He's stoked.
From California. The California vibe here.
This makes sense.
The good weather.
Yeah,
I know. But now, look, let me ask you about consumer sentiment, because there's the inflation squeeze pinches everyone's pockets, and yeah, inflation is easing, but the prices are still a heck of a lot higher than they were before. And this is something that we've been well established has been weighing on enthusiasm for the Joe Biden economic program. So how do you see consumer sentiment developing?
Well, just talking to virtually, all clients, they say, hey, Jeffrey, you saying that inflation is cooling off, but, I still see prices elevated at the pump, or I still see, expensive food prices. So, I mean, the difference there is just rates versus level. Central bankers are focused on the rate of inflation. I think the average consumer is focused on the level of inflation. So that's the disconnect you see. As a result, that's weighing on consumer sentiment. And so that's just a fact. I don't think there's any way around that. But this was brought to the attention. He already knows this, but Jerome Powell was asked about this last week on Capitol Hill, and he said, "Look, we're not expecting to see price level fall, the average price level fall. That only happens in very adverse, economic scenarios like a recession. What they're trying to achieve is a slowdown in the rate of increase, trying to get that back to 2%. But we've already talked about there's problems even then. I think inflation is a little bit stickier even on that slowdown."
All right, really good stuff. Appreciate the positivity. Jeffrey Cleveland, chief economist at Payden Rygel, he joins us there. But then on the flip side, you have Morgan Stanley's Mike Wilson says he doesn't see a need to raise the S&P 500 target. There's no justification in the absence of broad earnings growth. Now that is in contrast with an idea that maybe it's okay. Like we're not going to need a huge downturn in order to get Fed cuts. You can make do with 5, maybe 6 for the total cycle.
I mean, going back to the 1990s, rates around 5% or so, that's very long way from what it was at 12, 13% or what have you. And so if you think, where are we right now? This is definitely an area that we can live with.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's take another look from an investor perspective on what do you do now? Like, we got through CPI. It was a little bit of a sell into the news and then buy the news kind of situation. We're still going to grind higher here. So it seems Bank of America now upgrading their earnings forecast, really looking at a hyper investment cycle when it comes to the big tech guys. So what do you do? Margie Patel is Senior Portfolio Manager at Allspring Global Investments, and she joins us now. Margie, do you buy into this now? Like, is there, again, it feels like we just can't sell. So you have to throw in the towel here and buy no matter what and hold on?
Well, yes, because fundamentally the economy looks in good shape. It looks as if we're growing, say, between 2 and 3%, which is good enough to have earnings up, say, 10 or 12% for the year. So that's really pretty attractive for equity investors. And you can see the Fed is really betwixt and between. They'd like to cut rates, but they really can't when inflation is so stubbornly a little bit above their target. So that's why you're seeing mixed signals. Bond markets are down a little bit in price, but equities up a little bit in price.
Can you talk to me a little bit about your take on the equity market? Where do you see investors should be concentrating? Where do you see that they should be staying away a little bit?
Well, I think it's still the same themes that we had last year. Although the market might be broadening out a little bit, it's still sticking with companies that fundamentally look like they have above average long-term secular growth. So that says to me the tech sector is still going to be one of the strongest. It's certainly volatile as short-term traders change their sentiments here and there. Basically, I think the trend is still your friend in technology. And I think in industrials, particularly those companies that are going to benefit from reshoring, from higher capital investment in certain areas, I think those companies are going to do well. They're priced reasonably, and they should have growth that's actually pretty competitive, even with some of the tech sectors. And we've had a little bit of a turnaround in healthcare. People really trashed the sector because of down earnings from COVID. Mm-hmm. So I think we're seeing more money attracted to the healthcare sector.
What about industrials? We just heard Tucker talk about 3M changing CEOs. That has been a really rough ride for 3M. They pretty much like make everything, and they have so many parts of their business that sometimes that winds up hurting them. Where in the industrial space might you be looking?
Well, I think 3M is really a special case. You have to look at the company, the fundamentals. They just have a new CEO and look at it afresh. But as far as the rest of the industrials, I think that they should, on balance, look pretty attractive because a lot of them will benefit from higher capital expenditures. They'll benefit, I think, from the reshoring, less competition from, say, China, for example. And also, I think that as far as what we're seeing as far as the government with their encouraging more investment in semiconductors with needing to upgrade the electrical grid. I think those companies are going to do surprisingly well. They're priced reasonably, so I think they can easily be one of the more competitive sectors this year.
What's your view on more consumer-facing companies? You know, we're still seeing inflation quite powerful, and consumers still feeling squeezed, but at the same time, it's a hot job market, hot salaries.
Well, I think in the consumer sector, I think that the discretionary sector is likely to do a bit better than the staples sector, simply because people do have, more people have jobs. We have salaries going up small enough, maybe not enough to totally compensate for inflation. And the staples, I think, is a sector that I'm sort of lukewarm on. I think it's going to be hard to grow. There's excess capacity. They don't have pricing power. And fundamentally, those markets are rather slow growth. So unless a company can reinvest himself in the staple side, we think the discretionary is a better place to be for consumers.
Hey, Margie, do my homework for me. I try and come up with a couple themes every day. Like these are the main questions that we're all thinking about. These are the main themes. I gotta tell you, I don't have one today. It might be me. I mean, I'll put it out there. It could very well be me. But what's my question today? What are the main questions we have now?
Well, I think it's just more the same and really do nothing because there's really not a lot of productive things to do here.
Okay, so it's not my fault. My takeaway is that that's not my fault.
No. And position because they would love to cut rates, but they really can't when inflation is stubbornly high. Trends coming down, but not enough to justify cutting rates. And they're well aware of the interest rate burden with the huge deficit. So they're really betwixt and between. And so they really can't do much except maybe, talk every now and then. And the companies are just motoring right along. Earnings are once again surprisingly good in the last quarter. I think they'll continue to be surprisingly good. We have enough growth to sustain higher stock levels. So I think we'll see stocks go up this year, bonds be more or less in a trading range, I think, just because they'll be a little burdened by the supply of treasuries. And I think that'll keep the yield spreads of corporate bonds narrower to treasuries than we traditionally think. And I think when you value stocks by looking what the yield is in the 10-year treasury, you're going to miss a little bit, because I think treasuries are going to be somewhat higher than they would be if we had a so-called normal market, because of the very, very high supply we have.
There's one theme that will never fail us, and Alix, I think we can always have this in our back pocket, is the election coming up. And I think it would be an interesting thing for you to talk a little bit about how you see these trends developing in the second half of the year, bearing in mind that I think it's pretty safe to say that we're all gearing up for a very hardly, closely fought election.
Yes. Well, I thought coming into the year that the first half of the year would be very choppy up and down and not really make a lot of headway either way. It's surprising me with how well we've done in NASDAQ and Standard & Poor's, up well over 6%, Dow Jones up maybe close to 3%. So that's a little better than I would have thought at this point. My thinking is we may still chop around with worries about slower growth, inflation, or whatnot. But typically inflation in election years are good years for the equity market. So I think in the second half of the year, maybe towards the end part of the year, we should see a rather strong rally into the finish, regardless of which candidate wins. Because I think that it'll just reflect the lack of uncertainty and the fact the economy still has a lot of sustainable growth. I think that's what people missed in looking for weaknesses as the Fed raised rates. The economy is in great shape. There's no sector that's really out of balance. So I think the growth should continue.
But to your point, also, Jen, if you played the themes the last election, they didn't do anything for you. Like clean energy stocks fell after President Biden went in office, despite the IRA, for example, right? Even if you play those themes, it doesn't always work out.
Yeah, I mean, you can have a theme, but what it does for you is a separate question.
It's a very different story, yeah. Hey, Margie, you sound really positive. You sound really bullish. I mean, why would the Fed cut?
Well, because they'd like to cut, because they would like to see inflation come down. It hasn't obliged them. I think it's going to be a slow go on inflation. And as I said, they really are aware of the burden that interest rates are going to have as they go higher for financing the federal deficit. It's not a small factor. So I think they have to be well aware of that, particularly when we're likely to continue to have deficit financing as far as the eye can see. And I think they feel that lower rates would be healthy. Although I can't think of a market where if the 10-year was, say, between 4 and 5%, how that could be considered depression on the economy. I think companies have shown they're pretty resilient. They've restructured the balance sheet, and they're relatively insensitive to particularly moves in short-term rates. And really long rates aren't high enough to derail corporate profits. So we think you really have to be positive. If you look at the history books, you'd say, yes, the Fed is going to cause a recession, but they haven't now in 2 years. And I don't think that they would like to do that. I think they'd like to calibrate their interest rate adjustments to not damage the economy.
Yeah. All right, Margie, thanks a lot. We appreciate it. Thanks for jumping on with us. Margie Patel, Senior Portfolio Manager at Allspring Global Investments.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Oracle stock up 11%. So shares are rallying. You got the infrastructure software company reporting third quarter results that beat expectations on some key metrics here. We want to get more with Brody Ford, Bloomberg Tech Reporter, joining us. Hey, Brody, why was the street so surprised?
There's been a big debate over the last year. Can Oracle transform from this kind of old school on-premise, come to your office and install it on your servers kind of company to really offering cloud infrastructure the way we think about Amazon or Microsoft doing? The last couple quarters, they were disappointing and people were starting to wonder, is this a flash in the pan? Is their growth sustained? Yesterday, they said, hey, no, we actually got billions more in orders than you expected. They had really strong bookings growth. That's kind of reignited that enthusiasm that, hey, maybe Oracle really can be that, fourth hyperscaler after Google, Amazon, and Microsoft.
But I guess, they've been having their ups and downs. Their shares got really badly hit, relatively speaking. And so do you feel like the recovery today is for real, or what's going to be the next way station that investors have to look for?
So what's convinced them is that when you're offering cloud services, people forget the cloud isn't in the sky, it's in data centers in Virginia. And they need to build them.
It's my quote of the day.
Yeah. And so Oracle said that they're going to spend $10 billion next year just building up these data centers. And keep in mind, a couple years back, they were spending $2 billion a year on CapEx. Now it's 10. That's a real difference. And that's convincing investors that, hey, they are actually building out their physical infrastructure. In the AI era, everyone needs more cloud. Everyone needs more of this computing power. And Oracle does seem primed to actually capture a lot of that demand. So people will be watching whether these data centers do go up in Virginia and other states.
Wait, I thought we didn't like it when companies spend a lot of money on stuff.
We like it if it's going to come back and give us something else, right?
Okay.
I mean...
But what's that time? So they're going to invest all this money. When do they make money off of the money they just spent?
Yeah, it seems like it'd be pretty quick because if you believe the executives on the call, executives grandstand sometimes, but they say that demand outpaces supply. They've been saying this for a while, that with the AI era, everyone's rushing to get more computing power. They can't provide it. So the second these data centers go live, in theory, they should be able to convert that into revenue very quickly.
Are they good at doing that quickly relative to other companies?
They are known for ruthless operational efficiency. There is. So they should be good at this, right? I mean, of course, the market could change, right? Everything looks rosy with AI right now. Everybody wants to train their own models. Could we see a sea change? Hard to say. But yesterday they got $80 billion in bookings. Once you book, you can't get out of it. So at least for a while.
So I also find this interesting if we're going to see cloud computing and AI be a cyclical industry or not. Like clearly it's a structural shift, but will we see a ton of data centers come on at the same time, like from different companies, and then therefore prices go down so the revenue isn't as hot? Like will it be cyclical like chips are, for example, or not?
It's a good question. There's one rule of software compared to hardware, that software is a lot stickier, right? I mean, you buy chips, you have them, you don't necessarily need to buy more. Once you start giving money to software providers, you plan on X amount of computational power, that usually doesn't go down. I mean, is there a point where the growth will level off? Probably. I struggle to see it being like hardware where, hey, everybody bought computers this year. Now the computer makers are SOL because nobody wants to buy anymore.
And then they've got you on the subscriptions, basically, like what we all have at home. But now, can you talk a little bit more about how Oracle is benefiting from AI?
Yeah. Well, and that's the big question for a lot of software makers. Every software maker, when they have positive results, they say in their commentary, this is due to AI.
That could be anything.
Right. They call their new cloud version the Gen 2 AI. Is everybody using it for AI? No. But what we know is that AI requires a ton of computing power, and Oracle has marketed theirs specifically for being good at training AI models. And so there's reason to believe that folks are upping their demand due to AI needs. But is this more than a couple of percentage point difference? Most analysts don't think so at this point.
So it's still the cloud. It's the cloud, the data centers, building all that out.
Yeah, think about any companies running all these records, the terminal, anything like that. Just it's more that kind of traditional stuff at this point than it is training models, though. That's probably part of it.
I did want to point out, too, that maybe you can comment on this one, that Bank of America, reason why they upgraded their earnings in part was because of an investment cycle from big tech. Microsoft, Amazon, Google, Meta, spending $180 billion in CapEx. They're in that reinvestment cycle. And I'm assuming guys like Oracle are going to be beneficiaries. Is that a link I can make?
I think it is probably more that they're all riding similar trends. Amazon, Microsoft, they've spoken also in recent quarters that their customers are really focused on cutting costs. That for the most part, everybody had transported a bunch of things to the cloud and then they wanted to cut costs. And that behavior was starting to change. The 2024 budgets got approved. They started feeling good again. And the investment was going up. And so I think it's more that they're all riding a similar wave.
I see.
Let me ask you something internally about Oracle. Who's running the company? Is it Larry Ellison?
It's crazy, right? Because you think about somebody like a Bill Gates, that's the same generation. He hasn't been there for a decade or more. But yeah, Larry's still running that. I mean, his title is not CEO, but he's chairman and he's CTO. He's, on the earnings call talking back and forth with analysts. For someone of his age and his generation, it's rare to see him still running the company, but he continues to. And there's no reason to believe that will change anytime soon. So it's interesting.
What's the deal with that, though? Mm-hmm. I mean, why is he still around?
I mean, you found a company, it's your life. And for the most part, investors still like him. People still see him as this kind of tech visionary type. Every single analyst day, he takes questions for multiple hours. It always goes over time. It's almost like Putin's annual address when he goes with reporters.
It's a great comparison. We definitely want to live with that comparison. It's fair enough. But nonetheless, I do feel like the cloud is not in the sky. It is in Virginia.
In data centers in Virginia.
Might be the best line I've ever heard. Which, funnily enough, yesterday when EQT bought the midstream company, they did say that. They're like, all the data centers are going to be built in the South, and we need the natural gas to power them, so we're going to help send that there. Yeah. That's a narrative that continues to be building within that. Brody, thanks a lot. Brody Ford, Bloomberg Tech Reporter. Super enjoy your commentary. That was really helpful, I have to say. Cloud infrastructure conversations can really, really daze me. I did not get dazed on that.
I did not, because
nice job,
Brody knows his onions, as they say.
and he knows where the cloud is, not in the sky in Virginia.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One other stock that we're watching today is Kohl's, ticker KAS, or KISS. That stock is down by about 2.5%. Its operating margin forecast for the year did trail consensus estimates, and the midpoint of its annual earnings target range also fell short. To be honest, I've been to a Kohl's once in my entire life.
They send out the Kohl's Bucks, which, big discount. I'm surprised at you. You don't get that in the mail?
No.
Kohl's Bucks, they're like little, discount dollars.
I mean, I appreciated the store when I went in there, but when I ordered a pair of shoes for my daughter and they came in completely the wrong size, there is a small chance I misunderstood the size. But let's just blame Kohl's. I've been there once.
I've never been.
Wow. Tucker?
Oh, yeah.
Oh, he is the butt. This is where Tucker shops.
My pants? That's from Kohl's.
Maybe this is Kohl's problem. All right, let's get more insight.
I beg your pardon.
They need Jen and myself to go
there.
Oh,
I see.
They need us to go shop there.
Nobody would shop at a place I go shopping.
No, just that they also need us to go. All right, Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst, who covers retail, joins us now. Is that the problem? Jen and I need to go shop there, not just John Tucker?
Well, Jen and Alix, they do have Sephora. And I'm sure that Sephora carries the brands that you care about. So Sephora has been a key driver for Kohl's. And that's the reason why their sales aren't that bad. If you look at the comp sales, they fell 1% in the quarter at the stores. So total comp sales were down 4.3%, worse than consensus 3% estimate. But digital sales were down 10%. And now going forward, after we get beyond the first quarter in 2024, we should see the overall comp sales do better. One, with the Sephora initiative, because the comparable sales for Sephora was up 25% in the fourth quarter. So we've been seeing double-digit increases there. So that will help. But there's a number of other initiatives, including the news today, that they're going to be putting Babies R Us shops into about 200 stores by the fall. And that really fills a void in the market. I'm sure you're aware that, wow, what happened with Bye Bye Baby? And what about, remember, Toys R Us? That used to be a go-to place when you were expecting or had a baby. You could go there, get your strollers, get all your products there. So that will also help be a driver, and along with a number of initiatives that they're working on, including the home category.
But I guess if we talk about what's good in their future, it sounds like it's a lot of stuff that is not Kohl's. It's Sephora, it's Babies R Us. What's the issue with the fundamental core Kohl's offering?
So they're revamping the merchandise because that was part of it, is just not having the right assortment. So they're redoing shoes, and they're going to be bringing in Skechers. They already have Nike, they have Adidas. And now you're also going to see them bring in some youth brands. So they're going to bring in Quicksilver, Aeropostale, Madden, Limited 2, and Roxy. So those are also going to be helping on the apparel side. So with the overall revamp that they're doing on apparel, and some of their private brands are actually, they resonate pretty well. Like in babies, they have Jumping Beans, that does really well. Mm-hmm. So it's really a host of a lot of things that they've done with the stores. If you go in them now, they're a lot brighter. The culture there has really been boosted. We've noticed a difference just from a year ago on how much the stores have been transformed. And so that's helping.
Yeah, that's so interesting. When I went and I was looking in, kids grow like weeds, right? My daughter's 9, so I was looking for pants. And I was like, oh my God, they have Nike? I was like genuinely like it. I had lots of those moments whilst walking around.
I'm going to have to check it out.
It's also a place where I think you could still bring back your Amazon stuff.
Yes.
Yes.
So
yes. I've seen people do that
return.
too. But that's an excellent point. So, okay, we're listing the good stuff. So, Mary, why is the stock down 2.6%? Like, I just feel like it's getting beat up a little bit, and I'm wondering then the why.
So you raised a good point. You brought up earlier that they're going to be missing consensus estimates for operating margin next year. And part of that is because we had a new ruling that came out from the Consumer Financial Bureau saying, okay, we're going to cap late fees on credit cards to $8. So when that's going to have a negative impact for department stores generally, because they tend to have the biggest exposure. And so Kohl's is one of them. They generate a fair amount of income from their credit card portfolio. And so they guided today that that income will be down mid-teens. And that's about 135-ish million is what we're estimating the impact this year. And that's not the full year impact. But they introduced a co-branded card. And in 2025, they hope to be able to offset the loss of income that they'll experience. But we'll see. But that's one of the reasons why you're going to see some pressure on the margin side is due to that ruling that came out.
So what's the consumer favorite these days? I mean, we see you've listed all these interesting brands turning up at Kohl's, but is that enough to get the consumers through the door? Or, can you think more broad? Can you tell us a little bit more broadly about the retail space? Are there other shops that consumers are preferring these days?
Yeah, well, clearly off price. And when you think about what's happening here with Kohl's, they're buying more frequently, which is more of an off-price strategy. There, all the buying occurs on a weekly basis. Tom Kingsbury, who's the CEO, he is the one who turned Burlington stores into the fast-growing off-price retailer that it is. So he lends a lot of credibility, and a number of the initiatives that he's already employed is already demonstrating improvement. And so, yes, you're seeing the consumer, especially the consumer that's attracted to Kohl's, they also shop at off-price. And off-price has been a big winner for that value consumer. And then other retailers that are doing well are those that are executing and really delivering on the merchandise. And so I'm speaking to apparel retailers like Abercrombie, Urban Outfitters with their Anthropologie and their Free People brands. So it's kind of a tale of two stories. Those that are executing are delivering on results. And here we're in a transition phase at Kohl's, and they're hoping to be able to turn the tide of declining sales for this department store operator. And they do have one benefit. They're off the mall, not in the mall. And that makes them different. So it's easier, to get into the parking lot, get into the store and get out again. So it's easier access. And like you pointed out, they have Amazon returns. It's not additive to sales, but it does bring in traffic.
True.
And then more importantly, Sephora has been the biggest driver.
True. Really good stuff. Really appreciate that. Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst covering retail. Right. You go return something, you go buy something. I mean, that's literally my mom's entire life, shopping.
It's a very solid business strategy.
I'm just going to return it, and then I'm going to buy something when I'm also there.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.